G'day everyone, and welcome back to this Share Cafe Hidden Gems webinar. We appreciate your time. There's nothing from us today. It's pretty quiet across the desk. What I'll draw your attention to though is if you want to ask questions, type them in the box provided and we'll ensure that they get answered. So if they don't get answered live, ideally the CEO or presenter can answer them online. If not, we send those questions through to the CEOs next week. So don't be afraid to type in your name so they can be answered directly. Okay, let's make a start straight away. We have with us first up Black Mountain Energy, ASX code BME, market cap around 35 million. Doesn't have a one-year return, must be fairly newly listed. The company is an energy and resources company focused on identifying, developing and operating projects in hydrocarbon-rich basins. We have with us the founder and CEO, Rhett Bennett, who is coming to us live from Houston, I believe, in the States. Over to you, Rhett.
Great, wonderful. Thanks, Tim. Well, excited to present our company, tell everybody about what we're working on in the oil and gas industry in Australia, give a little bit of background on Black Mountain and how we ultimately went international in our search of interesting oil and gas deposits. So, Tim, if you want to flip to the next slide, kind of jump past all the disclaimers here. So a bit of the highlights. And quickly, a bit of background on Black Mountain. So I started the company in 2007. Over the last 15 years, we've built and sold 9 different companies. We're very familiar with early stage startups, done really well over the years with that and building assets and taking them up the food chain and ultimately monetizing them. So this is very much in our wheelhouse. All of our companies that we built have been within oil and gas. Probably most notably, we sold our New Mexico assets to Marathon for $700 million US about 3 or 4 years ago. So we know the playbook on advancing these projects. So bringing it to our Valhalla project specifically, we were entirely captivated with the thematic that long-term natural gas demand in Asia is going to be robust, and ultimately having deposits in close proximity to Asia's doorstep makes you very advantaged from an LNG perspective. So as we looked abroad beyond the US at interesting basins and assets to go pursue, we felt like Valhalla had a lot of differentiating aspects. Attractive cost of development. It already had gas to surface out of all the wells that Mitsubishi had drilled. So we're very much not explorationists at heart. Like, we like more execution. And so having a quantifiable deposit was really important to us. We've got tremendous support from the local stakeholders and TOs. And yeah, we feel like it's very strategically advantaged to Asian markets. And we've got the right skill set to commercialize it. Our team's drilled over 3,000 horizontal wells in the US. So very accustomed to executing at a high level. And recently, our project got a dump gas exemption from the WA government. So we do have the ability to take gas throughout an LNG, whether it be Northwest Shelf, Darwin, et cetera. So we can hit the export markets. So Tim, if we kind of jump to the next one. So here's an overview of our asset, and we looked at all the basins when we were evaluating what has the best unconventional potential within Australia, and staying cognizant that we wanted to be onshore. Offshore, I think there's a lot of issues with legacy liabilities that we probably weren't too keen to take on. So looked at the Beetaloo, the Perth, the Cooper, et cetera, but the Canning felt like it had the right size and scope for us. So altogether about 1 million acres. So really felt like it could be quite impactful. 1.5 T's contingent, close to 12 T's prospective resource. So really kind of platform type asset that frankly, we think will be $1 billion plus company someday. So we really liked it. In 2015, Mitsubishi had drilled 3 vertical wells, fracked 11 zones, all 11 zones flow gas to surface. So we found that just incredibly exciting. And keeping in mind that Mitsubishi was not a traditional onshore oil and gas operator. So That would be one comment. And then two, the advancement within the oil and gas industry on the drilling and completion side has been dramatic. And so even 2015 is, Gen 1, Gen 2 type completion style. So we get extremely excited about what the asset will be able to produce. And on the map, real quick, before we jump to the next slide, so in red is the Canning Basin, so in the northern part of Western Australia. And within the Canning, you'll see the purple polygon, and that is our Valhalla project. Okay, Tim, we'll jump to the next one. So obviously, social responsibility is extremely important. You have to have traditional owner buy-in, which we very much have that. Lots of letters of support, lots of potential jobs for the community. So they've been extremely enthusiastic about having economic development. So excited to have that in good shape. And Tim will jump to the next one. One interesting aspect, and whether you believe ultimately carbon has a tax or just an expense by virtue of offsets, your carbon footprint, does and will matter. And so one thing that we find very interesting and advantageous about our asset, you'll see on the graph there, it's about 2% CO2, which is, extremely low by any kind of relative measure. And when you look at Barossa or Gorgon and Browse, you're talking, order of magnitude higher. So in general, we think it's going to be low on the cost curve when you have to start incorporating your carbon footprint. So Tim, we'll get the next one. Obviously, environmental is huge to us, and making sure that we, operate in a culturally and environmentally friendly manner. So a lot of thought going into baseline studies, overall relative footprint of our activity. And one of the great things about the advent of horizontal drilling versus vertical is you've gotten to the point where you'll drill one well per square mile. So you're talking about a couple acres out of 640 acres. So extremely light footprint. So we really like that for the local environment. Tim, we'll jump to the next one. And I covered a bit of our background. Again, as founder and CEO, we've spent our whole careers within oil and gas. Been really successful in the U.S. With a similar playbook, and really we're quite intrepid and entrepreneurial. And our thesis started with, it's very presumptuous for us to assume the U.S. has the only good unconventional rocks in the world. So starting with, that's not true. Next is, well, what jurisdictions are interesting and in closer proximity to high demand markets. So Australia was a natural fit. We had already had a company based out of Perth, Black Mountain Metals, that had nickel assets, so very familiar with the operating environment. And so super excited about bringing our oil and gas expertise to Australia. And then we'll jump to the next one. Sit on our team. We won't try and walk through everybody, but a great mix of local Perth-based talent plus U.S. domestic E&P expertise that have really kind of spent their whole careers within the space. So got a great group of men and women kind of helping us execute the vision. Then we'll jump to the next one. And this is just a little more zoomed in view of the asset. The Valhalla asset being EP371 in yellow, and you see some of the existing drill holes on the asset, which gives us a lot of geologic data and comfort that within the Fitzroy Trough, you've really got an interesting stacked pay kind of situation with numerous zones of gas bearing rocks. So that's the more kind of close in view. Tim, we'll jump to the next one. And pathways to commerciality, super important. That's really all the basin is missing is access to both domestic and international markets. So we're putting a lot of thought into pipeline studies, pipeline negotiations, and ultimately, I think in all likelihood, the pathway being to the west and going over to Karratha Port Hedland, and both linking up to the Western gas system and ultimately having accessibility to LNGs in that proximity. So a lot of thought going into this, but a lot of really interesting optionality given the size of the asset. And the next one. And this is a little more of a granular take at probably what is the most preferred route, going west and accessing kind of Western gas markets and potentially Asian markets through Northwest Shelf tolling. So good conversations across the board on kind of the Western route and receptivity. So certainly that infrastructure is a bit short gas this decade, and so a lot of common receptivity to really kind of bring our asset into the system. So we'll go to the next one. So yeah, I think we kind of covered all the points. We think it's, we feel like we brought it to market at an extremely good value. Pre-money, Aussie 40 million, post-money 51 million market cap. So given the 200 million plus that Mitsubishi had spent on it prior, we're quite excited that the projects will advance versus where it sits currently at a market cap pricing. So super excited to give the pitch here and let guys kind of hear about what we're up to, and hopefully have you guys along for the ride. So
thanks, Rhett.
Yeah.
Thank you, Rhett. We've got a few questions here.
Sure.
There might be a little bit of static in the background. Now, next door, you've got the Beetaloo Basin, which has kind of seen significant government funding. Where is the Canning Basin position in regards to this conversation? I suppose you're looking for government funding in terms of the pipeline, are you?
So not necessarily government funding, and aware that the Beetaloo was able to get some government, support, which I think, we haven't spent a lot of time in pursuit of kind of, government grants or whatnot. Quite confident kind of in the private market ability to execute and finance. So not something we've heavily pursued on the government kind of funding side, if you will.
And where does natural gas sit in that funding conversation when you go and approach external funders? Given we know
Sure.
what's going on in oil and coal, for example, where does natural
Sure.
gas sit?
I would say there's been kind of a reawakening as to the importance of it as a potential bridge fuel for the next 40, 50 years. Obviously, renewables are great. We've got investments on the renewable side. So, we've got a foot kind of in both arenas. But what I would say is renewables are fundamentally a much different source of power. So you're really taking dispatchable, firm, deliverable power and replacing it with intermittent resources, which creates issues for the grid. So natural gas is kind of a baseline dispatchable source of power is really an attractive pairing with renewables given those dynamics. So it'll be around for a long time to come. So
and there's a question on that. Any financial success stories to report using this carbon neutral, smarter gas extraction?
Yeah, it's really becoming big in the States. So EQT, Toby Rice, a lot of guys are really pushing their companies towards more, responsibly sourced gas. So it is, I would say within 5 years, most of the industry is doing everything they can to offset scope 1, scope 2, and really kind of trying to be quite carbon neutral. So, the world will have a balance between, kind of the energy accessibility and dependability and, doing it responsibly. So we feel like that balance will need to be there. And certainly we intend to be one of those balance participants.
And just finally, can you comment on timing of drilling for 2022? How are your approvals tracking, and when do you expect to start drilling?
Yeah, so this year, in the States, our summer will be all about our seismic program. So we'll be kind of refining the landing zones, if you will, of the next batch of drilling, which will be late 23, early 24. So up until then, we got a lot of work to do, commercializing, negotiations, and kind of getting ready for drilling. So
excellent, thank you.
Yeah,
Rhett, we've got a couple more questions there, if you wouldn't mind answering them
Sure.
online. I think you've got some astute shareholders here. So
wonderful.
Thanks for your time.
Yeah, absolutely. Well, thanks for having me.
Thanks, Rhett. Okay, next up we have WT Financial. We welcome back WT Financial, ASX code WTL, market cap of around $23 million. The company's got a flat 1-year return. The company is a diversified financial service company that contains 2 distinct channels: B2B, operations under the Wealth Today banner and brand, and their complementary direct-to-consumer B2C operations under Spring Financial Group. We welcome back Keith Cullen, who's both the founder and managing director. Keith, over to you, mate.
Yeah, thanks, Tim, and thanks everybody for joining us today, and I appreciate the opportunity to be back on Hidden Gems. I'll start today by giving you a little bit of background for those of you that don't know the company, and then the real focus today, Tim, if we hop through to the first slide past the disclaimers, please. The real focus today is to take you through our half-year results for the half-year to the 31 December. So an important thing that we did during the period was the acquisition of our industry peer Sentry Group, and so I'll talk a little on that as well. But as to history, so WTL was founded in 2010 under the name of Spring Financial Group, and initially our complete focus was on building a diversified offering direct to consumers using all salaried advisors. And we enjoyed great success and we were profitable from our first year. And really our success was based on a great range of assets and intellectual property that we built around advisor education and training, consumer education, and taking a really process-driven approach to the creation of advice and to risk management, and also to client recruitment and digital marketing. We listed on the ASX back in 2015 under the profits test, and our original code was SFL. We had a very strong dividend history in our first few years, paying out around $7 million in dividends. Then sort of fast forward to 2017, and we saw significant legislative and regulatory changes in the industry, changes to education standards, the Royal Commission. A bunch of these things really impacted not just on the industry, but considerably on the company itself. And it forced us into having a rethink of the best way that we could unlock shareholder value from the assets that we'd built. And we made a determination to exit out of a lot of the B2C operations that we had and turn our focus into the B2B market. And by the B2B market, I mean this is, we started with the acquisition of a dealer group, what's known as a dealer group called Wealth Today. And what a dealer group does is it offers all of the licensing, infrastructure, business support, marketing support, and compliance regime, approved product lists, and the relationship with the with product providers like insurers and the superannuation companies and investment and asset managers. And it offers all of those services out to individual corporations, small operations generally of sort of 1 to 3 up to 10 or 12 financial advisors and their support staff through what's called corporate authorised representative or authorised representative arrangements. And so when we acquired Wealth Today, it had some 42 advisors. We've leveraged all those assets that we've got, now expertise, to grow that network up to around a few more than 100. And then we acquired our industry peer Sentry Group in the middle of last year. It was a bit of a rough ride for shareholders across those few years as we made that transition. We wrote down a lot of goodwill, disposed of assets, and really took some time to exit out of a lot of fixed cost arrangements we had around accommodation and so on. So it was a rocky road for a couple of financial years there. We're lucky to have very supportive shareholders in the base that went on supporting the business and then stumped up again to support the acquisition of Sentry last year. And it's really enabled us to see some significant increases and a return to strong profitability. So if you just flick to the next slide for me, having a look at the half year, this is really, the half year has been the first reporting period since what I would call the conclusion of the first stage of our real transition to a predominantly B2B focused business. Revenue was up significantly to just short of 35 million. Consolidated EBITDA was just over nearly 1.7 million. Consolidated net profit after tax of 1.12 million. Cost of goods sold, you'll see, is rather high in our business, and that's because the relationships that we have with our corporate authorised reps is the revenue that we bring into the business through insurance and advisor service fees and so on. There's a large share of that goes out to that advisor base because they're not salaried, they're running their own businesses, and so they get a considerable share. Most significantly, I think, was the containment of our operating expenses. So OPEX was up just 16% on all of those other terrific increases. So the next slide for me, please, Tim. We're on track for our guidance for the full year. Is when we made the acquisition of Sentry, our guidance to the market was that this financial year was really focusing on merging the two operations together, making sure we got the cost synergies there and contained our costs. And so our guidance for the full year was circa $70 million revenue. So we're sort of bang on half of that for the half year. We're still seeing good growth in the year. Our EBITDA guidance was for 3.3 million. So we're right there or thereabouts as well. And we gave guidance of the net profit after tax of $2 million or greater. So we're really pleased with where we're sitting at from a run rate perspective for the year. And we expect to be able to really bring it home in the second part of the year and meet or exceed what our guidance is in the marketplace. Depreciation and amortization. We did a lot of balance sheet restructuring at the end of the last financial year. And so we've been able to contain our depreciation and amortization. In fact, it was down 33% on the prior corresponding period to just 250,000. Finance costs were down also to 189,000. I'll just talk a little bit on the tax. We've seen a statutory tax expense of a bit over 100,000 for the half year. The company's in a rather unique position of having significant carried forward tax losses that it'll enjoy the benefit of, but at the same time, as we're sitting on a franking credit balance of around about $1.5 million, $1.6 million or thereabouts. So we'll be in that unique position. We're targeting a return to dividends as and when the profitability provides for that, and we're certainly on good track for that. With the board and key executives in the business owning about 30% of the business, is everybody's sort of motivated and aligned with shareholders from a dividend perspective. So we're in that unique position of being able to look to, when we do return to dividends, pay out fully franked dividends without the burden of having to make cash tax payments. So next slide, Tim. I think the key thing for our industry is that it's been a bit of a roller coaster for us in the wake of the Royal Commission. A lot of the banks and others have exited out of the space, but we're very bullish about the space. Demand for advice continues to grow. We've got some $3.5 trillion about to pass from one generation to the next over the next decade or two. And this means that there's strong demand for estate and legacy planning, for retirement income advice, for aged care advice, and of course for strategic investment advice for the recipients of that transference of wealth. And what this means is that people need financial advisors. They need financial planners, investment managers, and strategists in their life. And so we certainly don't see the demand going. We think the industry's got a very healthy future. These increased demands and the complexity of advice, however, really mean that advisors need to look to a dealer group with the sort of scale and structure that we've got to be able to offer them the right supports. And this also sort of marginalises some of the smaller players in the space. Next slide, Tim. I think we've got a couple of slides in this deck. Again, I won't get bogged down on the board, but we've got a great range of experience and talent, not just on the board. Myself and Guy Headley, Michael Harrison, Chris Colesis, Rob Jones heads our advisory committee, all really experienced in the financial services space, and also a lot of corporate M&A experience and equity capital markets experience in the team as well. The next slide, please, Tim. And I'll wrap it up with a slide there on great range of operators in our business. Our two joint chief operating officers, David Newman and Frank Paul, Jack Standing, Rick Jones, or Rickton Jones, our head of advice, and also Danny Marr, who's our regional head for the East Coast, all very experienced in financial services, a great team of people sort of backing the company and backing the advisors in the group. So really pleased with the results for the half year. We expect continued improvement and to be able to more than deliver on what our guidance is for the full year. So thanks, Tim. If there's any questions, more than happy to answer them.
Yeah, thanks, Keith. Quite a few questions. Now, we have seen lots of consolidation, and obviously the big boys have kind of moved away from financial advice to a certain extent. Does increased scale give WTL the opportunity to increase advice margins? We see that, the advice revenue relative to costs. How does scale reduce those costs?
Yeah, look, Tim, I think in any professional services business, obviously that your personnel costs are your highest costs. And if you want to support a dealer group on any form of scale where advisors have got real demands for support of that intellectual property they need, experience in dealing with clients with different circumstances, with different types of investment markets and risk markets and so on, you need to have a certain level of intellectual property in your personnel, and that can be expensive. So, but you don't, as the advice network grows, as long as you've got the IP in there, you can really leverage that across lots of advisors. And that's the importance of scale. We've got a really strong management team with incredible intellectual property that's very used to dealing with clients one-on-one and dealing in those B2C markets to support their advisors. And so that's one of the key areas where the margins can grow.
And do you see WT Financial Group playing a more active role in consolidation? And will your growth come from further acquisitions rather than organic growth?
Yeah, look, there's three ways for us to continue to grow our revenue and our profits. And the first is by adding advisors organically. And advisors are on the move. They're still looking to exit some of these institutions that are floating around. A lot of them are sick of working within a dealer group where, that what they tell me is that the management in the group has either forgotten what it's like to sit in front of clients or they've never known it. And certainly when they come to our group, they've got support from people that know exactly what it's like sitting in front of clients. So the organic growth through adding advisors, and then there's improving and broadening the services we offer to advisors as well, is another way to sort of grow the margins and grow the profitability of the group. And of course, lastly, the transactional opportunities, and there's plenty of them in the market. There's a number of smaller players. There's also a number of large privately owned businesses out there where the principals are sort of getting towards wanting to transition to retirement themselves. So there's a number of players out there with 100, 150, 200 advisors that are privately held still, where their principals have never had a capital event. And then, of course, there's merger and acquisition opportunity amongst the listed peers.
And just on those listed peers, can you talk us through how you're kind of similar and how you're unique compared to those competitors?
Sure. I mean, I think really we're what I would call a pure play into the dealer group market, into supporting independent financial advisors. A lot of the others, like Sequoia, for example, or Climb Asset Management, or Eastern, now called Diverger, they have sort of a whole bunch of bits and pieces to their business. They're doing certain things with accountants. Sequoia is a great business from a share market performance perspective, but how it differs from ours is that they're producing some product, they're doing a little bit of this, a little bit of that. We're really staying focused on being the pure play and being the dealer group of choice for advisors. Probably the closest listed peer to us, I'd say, would be Centrepoint Alliance. They're very much that sort of pure play in the dealer group space as well.
And how are they priced, like relative to PEs and things like that?
Well, look, if I look at what the PE ratios that some of our peers are running on, I'm typically seeing 16 or 18 times, and that indicates to me that I think, you know, we're trading at about 8 cents at the moment, based on an annualisation of our half-year results. As if you applied that 16 to 18 multiple to us, as you should land at a market cap of 35 to 40 million, which puts us in that sort of 12 to 15 cent range. So, you know, I'd suggest, and I think I was looking at some Morningstar sort of automated research the other day saying fair value for our stocks about 14 cents, and I think I'd have to agree with them if you line it up against industry peers, and that's without considering what our growth opportunities are.
And Keith, as a pure play, in your words, what's the sort of target numbers you'd like to get to in terms of number of advisors, and how do you balance out that ability to service an increasing consumer base that's looking for financial advice?
Yeah, look, one thing that our team's been really good at, Tim, has been developing processes inside the business that are really scalable. And we do this through, you know, very careful outsourcing of certain components of the business that mean we're not increasing our fixed costs and that we've got variable costs associated there. And we've always been very process driven. It was where our success came in the early days in the B2C market, was being very process driven in the business. A lot of dealer groups have suffered from this problem of, as they've got bigger, they just keep throwing more and more people at it. And they think that the way they solve any problem in growing their business is to throw people at it. It's not necessarily people, it's generally, you know, processes and technology. And so, look, where's our ideal number? I don't have an ideal number in mind. If I look at our larger peers in the market, is you've got AMP and IOOF with sort of 12 and 1,500 advisors. There's certainly the opportunity for one or more of us in what I would call the independent space, you know, the non-institutionalized space, to start to rival those numbers over the next 3 to 5 years. But certainly we've got great capacity in our management team to grow significantly from here, and still be able to provide the right proposition for advisors.
Great, Keith. That's all we have time for. We'll finish there. Have a good weekend, and we'll get you back on a couple of months' time and follow your progress.
Thanks so much indeed, Tim, and thanks everybody for joining us.
Thanks. Next up, we have Emyria, ASX code EMD, market cap of around 91 million, 1 year return of up 88%. The company is developing technology-powered health services that elevate clinical care and develop and deliver deeper clinical insights. We welcome back Micheal Winlo, who is the company's managing director. Micheal, over to you.
Yeah, well, thank you very much, Tim. And it's my pleasure to represent our terrific company and the wonderful people behind Emyria this afternoon. Emyria is a company that's developing new medical treatments for patients with unmet needs, but we're doing that with a really unique approach. We're actually guiding our programs by the patient data from patients that we provide care for across our medical service subsidiary. Go to the next slide, please. So what that looks like in practice is that we have operations in 5 different jurisdictions around Australia. We have now treated more than 6,000 patients. Each of those patients has a clinical condition that's not responding to usual treatment. And in the aggregate, that's 40 different unmet needs that we are providing care for patients as young as 2 and as old as 98. And by paying careful attention to how those patients are doing on treatment, we're able to build an incredible data asset that guides our drug development programs. And we've launched 2 to date, and I'll speak about those today. Next slide, please. So our primary programs are running in 2 main streams. We have a ultra-pure cannabinoid drug development program. We've developed a unique dose form, Emdr X5, which we think has potential to address multiple different clinical indications. And we're starting with a major unmet need of psychological distress and seeking registration in Australia as an over-the-counter medication. We also have an incredible asset in a library of more than 100 Mdma analogs. Mdma may be known to some of you as ecstasy. It's been shown to be an incredibly profound treatment when given alongside psychotherapy for major mental health disorders. And we believe that by examining this library, looking for new ways to adjust that molecule, we can come up with next generation psychedelic assisted therapies and also new treatments for neurological disorders as well. Next slide, please. So first of all, our cannabinoid development. Next slide. As I mentioned, we have this incredible data set that's guiding our program. We treat a wide variety of patients with a wide variety of treatment regimes. And so we have this exquisite insight into what doses are working for which problems and in which patient cohorts. And it's those insights that allow us to design a registration program, pick an indication, craft a clinical trial program that can achieve registration with major global regulators. And each of those primary indications represents an unmet need. Each of those conditions represents an opportunity for a standalone drug development program. And we believe we're really uniquely positioned to take advantage of that and develop treatments that can improve the lives and well-being of many, many patients around the world. Next slide, please. But one of the key things we're focused on is developing a reliable and consistent dose form. 40% of our medications that we take today, at least in the top few that are prescribed, drew their inspiration from plants. So if you're taking a statin to lower your cholesterol, that molecule was first isolated in a fungus. If you've ever taken an antibiotic, for example, you may be aware that, of course, that came from in a study of a penicillin mold. Aspirin was first isolated from the bark of a willow tree. But of course, today we're not taking teas of willow bark to help our pain. We're not eating mushrooms to try and bring our cholesterol down. If we're taking a medicine, we're taking a reliable, consistent, high quality dose form. In the world of medicinal cannabis, we're still kind of stuck at this 2.0 phase. We recognize that there may be a value to medicinal cannabis, but people are still taking it as tinctures, mixtures of oils, gel caps. We think the next evolution is coming. That's medicinal cannabis 3.0. And what we'll see is dose forms that we are familiar with in reliable, high quality, consistent forms. Next slide, please. Great. So we've actually taken the approach to look at a synthetic CBD. So this isn't just about extracting the CBD out of plants. This is making it in a true biopharmaceutical process. Through that method, we can ensure an incredible quality in the CBD that we're using, with absolutely no detectable THC, which is the psychoactive component of the marijuana plant. And you can see on the right there that even in the highest quality registered medical treatment, there is still small quantities of THC present. We're also ensuring that we're only using the biochemically active component of CBD with very few other impurities. Our technologies also allowed us to increase the bioavailability of our drug form. Bioavailability is a measure of how much treatment actually makes its way into the bloodstream so it can be effective. CBD is notorious for having very low and poor bioavailability. And so innovations that can improve that count for a lot. And we think we've got a terrific way of delivering CBD to increase its bioavailability. And in the long term, we believe the synthetic approach will allow us to have cost advantages as well. Next slide, please. And the one after this. So our first program is Emdr X5. It's focused on psychological distress, and we're seeking registration as an over-the-counter treatment. Psychological distress is a cluster of symptoms. It can result in sleep disturbance, anxiety, stress, depression. Affects about 15% of us. And we know the incidence is growing, particularly given what we've endured in the last couple of years. And currently, there is no over-the-counter treatment for this condition. Next slide, please. We also know that huge recognition globally for the mental health crisis. President Biden, a couple of days ago, next slide, please, called out mental health as being a major priority of his administration, announcing huge funding for this and recognizing that many adults now are reporting symptoms of anxiety and depression. So we believe an effective, proven treatment to ameliorate the short-term symptoms of anxiety and psychological distress has tremendous upside. Next slide, please. And tremendous value. So what does that look like? We think an over-the-counter medicine is possible. The TGA has allowed CBD at certain doses to be available over the counter once registration's been achieved, and that allows this treatment to be available to patients without a medical prescription. And with a huge network of pharmacies around Australia, we think this represents a massive market opportunity, and really it's a stepping stone to bigger and greater markets for us, as all of our program has been designed to meet the requirements of the FDA and other major global regulators as well. Next slide, please. So how do we get to this? So just to show off how we were able to come up with this insight, we had more than 600 patients taking a low dose form for psychological distress. We're able to see how they were responding. We're able to define that population to get a good idea of which patients were responding most effectively to that treatment regime. And then through that, develop not only a unique dose form, but also selected the indication, the pivotal registration study program, and we're making progress on that program now. Next slide, please. We can do this again. So just having a look at the progress today. This is a technical slide. I'll let people probably read this in the downloadable version that's available on the ASX. Needless to say, we've taken a very sophisticated approach to our drug manufacture to ensure that it would meet the strictest requirements for registration, not only at the TGA, but the FDA also. Important to note out that our ethics approval for our phase 1 study was granted yesterday, and we can start that dosing and recruitment later this month. Next slide, please. Great. Here's a little slide on the bioavailability advantages. What this is a measure of our drug distribution in the bloodstream in a gold standard animal model that we just completed. And you can see the comparison there between the only registered medicine, Epidiolex, which in and of itself is a multi-$100 million a year medication. And the manufacturer of that medication was sold to Jazz Pharmaceuticals for $7 billion in February last year. You can see that we outperform that drug in terms of bioavailability, which means more of the active ingredient is delivered to the bloodstream where it can be useful. And we think this is going to have a huge impact in the patients that we provide this treatment to also. Next slide, please. Great. So what can we do next? We can look at our data. We can look for additional indications, additional opportunities for Emdr X5, and develop programs for those. Our data also guides us to new combination treatments as well, where we can look at novel medications combining CBD and THC. And of course, as I mentioned, 40 different clinical indications available and responding to treatment. And so we can design custom programs for each of those markets and build out a pretty impressive portfolio of treatments for major unmet needs. Next slide, please. And here's a timeline. I'll just say here that trials are about to commence. We'll commence our pivotal clinical trials soon after our phase 1, later in the Q2, and look to submit to the TGA for registration approval by end of the year. Next slide, please. And one of the other areas that we're developing, thank you, is psychedelic assisted treatments. So these are the administration of things like psilocybin or Mdma alongside trained, experienced psychotherapists. And clinical trials are showing that this is having tremendous, profound benefit on patients with really difficult major mental health disorders. And consequently, there's a massive amount of investment happening in this space. And we think we're uniquely positioned to lead, not only because of the way we've set up our business with clinical care services, which are providing frontline care, the incredible data capture we're doing, but also our ability to develop new treatments. Next slide, please. One of the really key assets we have, next slide, thank you, is an Mdma analog library, which we have an exclusive access to in partnership with the University of Western Australia. This is a library that's been growing over 15 years. It is still growing. There are more than 100 different Mdma-like compounds. These are compounds inspired by the original Mdma, but adjusted slightly to elicit hopefully different positive therapeutic effects. And we're currently screening and testing that library for new compounds. And we think it has tremendous potential, not only to become next generation Mdma for it to assist therapy and allow more patients to have benefit from that treatment, but also we see opportunity for these treatments to become typical mainstream medicines for neurological disorders as well. Next slide, please. And then one after this. So we're also involved in some really incredible research, including a trial that is in planning, and we expect to kick off this year, looking at Mdma for PTSD, where we're also layering in remote monitoring technology to get a better sense of how the patient's faring to help guide therapists through these sessions. Next slide, please. And it's this kind of research that we have the privilege of being able to do, and the unique access through our clinics, our physicians, and our patients can help build really unique insights, and that supports some of our intellectual property as well. You can see we have a growing portfolio of patents that support our programs, our dose development, and our innovations. Next slide, please. So quickly on the corporate structure, tremendous board who's done this before. We've got FDA approvals on our record. I'd like to just touch on two people, Dr. Karen Smith, ex-Chief Medical Officer and Global Head of Research and Development at Jazz Pharmaceuticals. The company I mentioned acquired GW for $7 billion. Also Matt Callahan with 4 FDA approvals in the area of pain medications in the United States. And with this experience, these experts are guiding our team in all of our registration programs as well. Next slide, thank you. Also like to point out here that we have a really tight registry. We have great support from major institutional investor in Tattering. That's the private wealth fund for the Forrest family, recently provided $5 million. Gives us a very strong cash balance sheet, 8.7 million at the end of last year. Next slide, thank you. And finally, just to recap, 6 key points of why we think we're a terrific investment and worth betting on. We have this great board and management team who've done this kind of thing before. We've got incredible assets in the form of our data that's guiding our drug development programs, targeting major unmet needs that are globally significant. We've got a really unique cannabinoid dosing platform and dose form, which we think can serve multiple indications. Got this tremendous library of MDMA analogs with huge potential. And all of that, I think, gives us a very attractive valuation and a lot of upside ahead in the years to come. Thank you very much. Welcome your questions.
Thank you, Michael. I do remember your presentation from last time. It's a shame I wasn't a shareholder. Now, you have raised some capital through Twiggy Forrest, the family office. How do you balance this capital allocation with, the need to get regulatory approval, trials, and research?
Yeah, clinical trials and drug development is a very long and expensive process. So you need to be really strategic in how you're allocating your capital to de-risk the program as you go. And so, each of our programs is essentially sequenced and staged with various, value creating gates. First one being for our X5, for example, the phase 1 trial, which is all fully funded, and also our phase 3 study. And I think the successes in those will allow us to, show the potential that we have, raise additional funds to support our other programs coming in parallel.
And how confident are you in this question here in terms of your timeline to have sales by the end of 2022?
Yeah, the wrinkle there is really how long the TGA will take to consider it. They've not approved a Schedule 3 medication in the cannabis field before. They allow themselves a generous timeline, somewhere between 100 to 240 days to make an approval. And so that's probably the big unknown here. But we're on track to get our phase 1 done very rapidly. Our phase 3 will follow. And we also think we can do that incredibly quickly. So I'm confident we'll have a submission well before the end of the year. And then it's really up to the TGA on when they can approve it. The very best case scenario would be the end of the year or likely early next year.
And does a synthetic cannabis product, is that treated any differently from a natural cannabis product in terms of trial approval and regulations?
It's not actually. In at least the early conversations we've had, there's some comfort from regulators in a synthetic. It's a known entity. It's got known pharmacokinetic profile. It's a known chemical entity. Regulators are more cautious of plant extracts where you can control some of the cannabinoid elements, but not others. And so you have to have some tolerance for other things that might appear in the medication. So we know that for a fact that the FDA is incredibly strict on the CBD purity levels. Synthetic allows us to hit that easily. I think it's more difficult for extraction companies to hit the purity level that the FDA is seeking. The TGA is a little more tolerant. But still, I think generally the attitude is that regulators approve of synthetic approaches, given that we can control more of the variables in the medication.
And the FDA, where do you see yourself positioned in regards to that timeline? We all understand that that's a slow process. It's hard to give a confident deadline, but where are you positioned there?
Well, we're already doing the hard work right now, picking the indication. We want to make smart moves towards the FDA. We've got, again, a long list of indications that we think are all potentially suitable drug development programs focused on the US. But absolutely, we're seeing through the TGA approval, which we hope to achieve end of this year, early next year, towards the FDA, and making sure that everything we do is additive towards an FDA submission program as well. But I expect that in the next few months, we'll be approaching the FDA with some of our programs in mind, and we'll be able to talk more freely about those in the coming months. But we're absolutely focused on FDA as the long-term play for our drug registration programs across everything we do.
Thanks, Michael. That's all we have time for. Nice to have you back. Love to see you again in 6 months or so.
Right. Thanks, Tim. Cheers. Appreciate it.
Thank you. Next up, we have Comms Group, ASX code CCG, market cap around 38 million, 1 year return of up 43%. The company is an Australian-based business involved in telecommunications, ISP, and managed service provider. The company provides cloud communications for businesses. We have with us the CEO and Managing Director, Peter McGrath. Thanks for your time, Peter. Over to you.
Thanks, Tim, and thanks for any current shareholders listening and also potential future investors. Just move to the first slide. Okay, Comms Group at a glance. What do we do? What makes us unique? We focus on the B2B or the business market, and we're really focused on provision of services from the cloud. In the ICT space today, the majority of services are moving to the cloud, and this includes telephony-based services for corporate communications. Our goal is to enhance business agility, as you've seen there, and we service our customers through 3 key divisions. So we have a domestic business called Next Telecom. We've brought a number of other businesses in under that brand. We're a significant player today. In some markets, we're one of the leading players. For instance, in fibre optic services provision to businesses, we're one of the leading providers of services there today. We also have an international group, Comms Group Global, which is a global specialist provider of unified communications, and I'll explain that shortly. And then more recently, we've just bought a business called On Platinum, headquartered out of Queensland, also based in Sydney, and that is an IT services business. So that's the overall group. We've got circa 150 staff, about 140 staff, but we're separating our domestic, our IT services, and also our global business across the group today with different branding. We see that's the best way for us to get the type of breakthrough that we need in the market. We'll move to the next slide. Bit of a key timeline of events here. I just want to highlight 2 or 3 key things. So we're a strong domestic business-to-business or business-focused telco service provider. We focus mainly on the mid-market corporate, but one unique differentiation with our services compared to most of the other providers is that we have a real strength in the latest voice services. So back in August 2020, we expanded our Microsoft Teams calling network to large parts of Asia, into US and Europe. That was a significant step in our business evolution. We acquired Next Telecom in December 2020, which is a major SME and corporate or mid-market provider. We also acquired a business called Binary, based out of Melbourne, which gives us a significant domestic network and our own infrastructure-based services. And then more recently, as mentioned, we acquired On Platinum. That transaction finished in the last few weeks, and that's added circa 45% to our overall revenue. But importantly, gives us now the ability to sell a full range of services, as we'll see on the next slide, to both the SME, the corporate mid-market, and even into the enterprise segment of the market. And the way we differentiate that, typically enterprise businesses are large multinational organisations with typically 1,000+ seats. I don't intend to go into the detail of our product set here, other than to show you that we have a significant product capability to satisfy customer needs. We're also big in the wholesale space, particularly globally, but we have this key differentiation being this unified communication solution. We were one of the first to roll out a Microsoft Teams calling network domestically back in 2018. And as mentioned, we then expanded that globally. Move to the next page. So in the Microsoft Teams space, and particularly with Microsoft pushing Teams, Teams is one of their fastest growing applications. I believe there's something like 40 million plus users globally today. And when you look in the mid-market and above into the corporate and the enterprise markets, the software solution of choice for those businesses that want a unified communication solution, so video, messaging within their organisation, file storage, the ability for staff to work remotely from anywhere in the world, we decided to partner with Microsoft back in 2018, and we've expanded that. So now we have a full range of applications, if you like, that we can provide to businesses. And we'll see on the next slide that we have also a significant global network. This is unique to the extent of the Australian market. There's no other providers that have this type of network offering, and we're one of the leading providers globally today, but particularly into the Asia Pacific market. We can provide calling solutions using Microsoft Teams calling into 100+ countries across the world. So if you're a multinational, you want to introduce Microsoft Teams calling and you want the true unified communications experience. In other words, you want to make and receive telephone calls in any market around the world. That could be the US, that could be Indonesia, Hong Kong, Singapore, Tokyo, etc. We can provide those services to you. Move to the next page, please. A bit on our most recent financial highlights for the half year just recently gone. As you can see here, we had significant growth in revenue for the first half, also in EBITDA compared with the year before, also in gross profit, and then our gross margin is running just below the 50%. And we're able to achieve these significant growth margins because of our own core network that we have in place. We also released an update to the market recently with the acquisition of On Platinum that we expect annualised revenue to be north of 50 million and our annualised underlying EBITDA to be north of 7 million. If we look on the next slide, we'll also see our performance over the last few years. So if we go back to the comparable half a year ago, we were at 9 million. Revenue, we've grown that to 17.3 million in the latest half. Our underlying EBITDA has increased as well. In the last half, we had some increasing costs. We're now investing in some additional sales and marketing resources and looking to put in more advanced systems to the benefit of both our customers and our staff working across our global network. We have a look at the next slide. You'll see the revenue has grown from 19.1 back in FY20 to 25, and in the first half was 17.3. And we've given guidance of revenue to 40 million to 40.3 million for this particular year. And that's to June. We'll move to the next slide. Some recent business highlights. We're continuing to have some significant wins with global multinational corporates. These are organisations that have offices around the world. And really pleasingly, we're also working with a number of global telcos in the wholesale area where we provide our services that they can go and resell to their customers. And we would expect that that would be a continuing trend in our business, where we would look to partner with some global enterprise services businesses who service the large corporates around the world. A particular strength there is obviously in the Asia Pacific region. We did more recently announce a partnership with Vodafone Fiji in September last year, and they're effectively using our services, our network, to provide services to their own customers across the Pacific region. We announced the acquisition of Switched On Australia in August 21. So that's, from our perspective, a great acquisition. They're a leading provider in the mid-market sector with circa 500 customers with an ARPU of around $3,000 a month, provide a full range of IT services, including cloud and security services. And pleasingly for us, it increased our overall revenue by around about 40%, which is taking us to that over 50 million level. We also closed in the half some great sales, as mentioned, in the enterprise and also the SME and wholesale area. And we've just given a number there of 235K of new MRR. And we did quite a lot of work in terms of new systems, which we will continue to invest in for the business. We'll just move now to our outlook. So we're going to focus, obviously, continue to focus on our growth journey. And some of the areas that we're going to achieve that growth is through that continued focus on the corporate mid-market sector. So those mid-market corporates, 500 employees and above, up to 1,000 employees, we now have a full range of services that we can provide to them. We intend this year to continue to invest in our Asia Pacific expansion. We do work with a significant number of carriers within that region today, but we intend to expand on that and allow ourselves to provide services deeper into some of those key markets in Asia. We've indicated to the market that we'd like to see our revenue north of 100 million within a short period of time, so that is a goal that we have. We've got a very healthy pipeline of sales that we're focusing on today. But with the more recent acquisitions, we've made 4 acquisitions in the last 12 months. We're also focusing on extracting synergies so we see a growth in our bottom line as well. And we also want to expand domestically. So today we're in New South Wales, Victoria, Queensland. We want to look to see if we can expand into a number of the other states over time as well. That's all I wanted to focus on at this stage. I'm very happy to take questions.
Thanks, Peter. A really interesting story. Now, with your acquisitions, are you buying technology, customers, or revenue? And are you looking at the ability to kind of cross-sell different products into different clients?
Yes. So in the case of, say, Binary, we definitely acquired technology as well. They're very strong with their data services, with their internet services, and that's given us greater capability. That lowers our costs, but also enables us to sell our own branded products. The example would be NBN type services. Next Telecom gave us significantly greater customer base, but they had the types of services and products that we had, so we could extract significant synergies from that, Tim. And I think with our On Platinum acquisition, it's really to give us greater capabilities, but they have some product set that we can also resell and cross-sell. So we've got greater capabilities, IT services, but they also have we have the ability to offer those to our growing customer base.
And is the opportunity here to kind of consolidate some of the smaller players within Comms Group, and who are your competitors out there as well?
Okay, so I'll firstly cover competitors. I think our key competitors domestically would be a number of listed telcos, the likes of, say, Over the Wire, Symbio to a lesser extent. They're more focusing on wholesale, but internationally they'd be a competitor. Obviously, Telstra, Macquarie Corporate Telecom, Optus, Vocus. They're some of our competitors. In the UCaaS space, where we have this global network offering, the competitors are more global. Your Tatas, your NTTs, and some Northern Hemisphere providers. But within our part of the world, we're winning a good share of business, and we expect to do more and more in the wholesale space. In terms of acquisitions, just very briefly on that, one thing I should mention is we're seeing a great pipeline of future acquisitions. We've been fairly selective. They need to meet certain criteria. There will be an element of consolidation, but we're not that interested in buying at the small end of the market. We're more so interested in those mid-market corporate providers that will give us greater capability and also have some very good customers.
And a lot of this comes down to execution. Can you touch a little bit on management? I was reading, your management has a lot of experience in terms of execution in this space.
Yeah, so I think we've got a strong management team. We haven't included that here, but obviously it's on our websites. If we look briefly at my background, I've run a number of significantly bigger businesses than this that we grew both by acquisition and by organic growth. Organic growth is a great opportunity for us. So we're very focused on where we want to grow the business. We're not just growing willy-nilly. In the UCaaS area, we see that as a great opportunity. So we've identified some M&A opportunities there, but we'll also look at some organic growth opportunities there that we think could be quite exciting over time. Within our SME division, we've got a couple of leaders there. This is our Next Telecom business who are, basically, I would have to say some of the best in the country. Within our IT services business, we've got a proven management team there. And within our global business, we've got some great people with a pedigree of experience in the marketplace, and we're continuing to add resources to that business as we move forward.
And Peter, you got an EBITDA there of 7 million and a market cap of around 37 million. You look cheap. Can you talk through some of the kind of multiple comparisons you see and where you think you should be valued?
Yeah, so look, I think to add to that, we used debt to fund predominantly the acquisition of On Platinum. You know, we're very mindful we don't want to go and dilute existing shareholders too much. We have a very tight share register. Probably 60% of the register is held by people, you know, who are very close to the business, who've been supporting the business and major shareholders, etc. You know, we're probably trading on the 5, 6, 7 times EBITDA, and I think you'll see some of the more exciting UCaaS-based providers that are probably trading on the 15 times up to 20 times EBITDA. Obviously, we need to get the runs on the board. I think we've proved over the last couple of years that, you know, we can deliver. I think it's really the next phase of our growth that's going to be the most exciting for the business. We've bettered down a lot from the past. Really it's up to the market to determine what we're worth fundamentally, but I think, you know, the market will reward businesses that deliver with the type of growth and some of the wins we hope to see moving forward.
And just a final question, how do you win new business given how competitive the kind of telecommunications market is?
Yeah, so in our SME market, you know, which is, you know, to us probably a $25 to $30 million business today in terms of turnover. We have a direct sales force. We also have an indirect sales force. We have a number of key partners we work with. Yes, that element of the market is competitive, but we have some very good products, and our service, you know, Australian-based service is second to none. So you ring up our SME division, they'll answer the call within, you know, 3 or 4 rings. You're not going overseas and finding that you can't speak to someone. We want to fix our customers' problems on the first call, if they have any, or sell them more services. So I think differentiation through customer service is key. And then globally, we're really looking at growth via partnerships and actually selective wins in the enterprise area as well. And we shared some of that in our full year result. You know, we will continue to win direct business with enterprises, but we see further growth through some of our key partners who have great customer relationships.
Great, Peter. That's all we have time for. Thank you for your presentation. We will follow with interest and get you back on the second half of the year.
Okay. Thank you, Tim, and thanks everyone for listening.
Thanks, Peter. That's all we have time for, everyone. Thank you again for being on the webinar. We'll see you again next week.